Hello viewers, welcome to my channel. I'm Hasham Khan. So now I'm going to start the next problem number 10 on ratio analysis. So far in the last problem I have completed 9 main problems and 16 short problems. So if you want the complete command, you should keep a rhythm of watching one after the other videos. If you join in between, you will not be able to understand, because all the videos are interlinked with one another. Basically, before watching this topic of ratio analysis, first of all, you must know what do you mean by ratio, what are ratio analysis, why it is used, what are the advantages, what are the limitations, and how we have classified the ratios according to liquidity, leverage or capital structure, activity or turnover, and profitability. All these things I have explained in the starting 3 videos. So my suggestion, if you are genuinely interested in learning this topic, watch the beginning first 3 videos. You will get the complete command, the meaning. Then starting videos I have explained you the formulas. All the problems are based on the formula. If you are perfect on the formula, easily you can do it. Otherwise it will be a difficult chapter for you. So if you have not watched the earlier videos, I suggest you to go to the playlist of my channel. Select the subject financial statement analysis. Select the topic ratio analysis. Watch the starting 3 videos on theory. Then starting videos are very important. There I have explained you the different formulas. Not only you have to remember the formula, but also you must know the significance of each ratio. Now I am going to start the next problem number 10. So before starting the problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. So take a printout and keep it ready before start watching this problem. Now 10th problem I am reading out. Following information is given about ABC Limited in 1990-91. So what information? Profit before tax in lakhs of rupees 48.92. So 48.92 lakhs. So in other words, we can say 48,92,000 is the profit before tax, and the tax rate is 60%. Then proposed dividend. This proposed dividend is on equity, because on preference shares the rate of dividend will be fixed. There is no proposal. But in case of equity shareholder, every year the director have to propose the dividend. So current year proposed dividend 20%. Capital of the company include 9% preference share capital 20 lakhs and equity shares 30,000 shares of rupees 200 each 60 lakhs. Reserves at the beginning of the year 44 lakhs. This is the complete information given. Calculate for equity shares. Earning per share, first ratio. Second, book value per share. Earning yield ratio. Dividend payout ratio. Price earning ratio. 5 ratios you have to calculate. The current market price of equity share is 400 rupees. The current market price 400. This problem is very important. You are going to learn a number of new concepts in this problem. The ratios which we are going to calculate are new one, which have not come across in the previous problem. First of all, we have to calculate how much is the balance in P&L account after making appropriations. So after making appropriation, what are the balances we have to find out. First of all, profit before tax is given 48,92,000. This is the profit before tax. So first of all, we should deduct tax at the rate of 60% given in the problem. So tax 60%. 60% of 48,92,000 will get 29,35,200. This is the tax. Deduct tax will get profit after tax. The profit after tax 19,56,800. So after paying the tax, we get profit after tax. Now we have to make the appropriation. First of all, dividend should be paid to preference shares. According to the Companies Act, according to the law, first of all, dividend must be paid to preference shareholders. After that, dividend can be paid to equity shareholders. So how much preference dividend has to be paid? It is given in the problem 9%. 9% preference share capital 20 lakh, that is given in the problem. Share capital 20 lakh, preference share capital 20 lakh, on which dividend is payable 9%. So 9% of 20 lakh, it comes to 1,80,000. So 1,80,000 is the preference dividend. So deduct preference dividend, we'll get 17,76,800. Now we can pay the dividend to equity shareholders at the proposed dividend. The proposed dividend rate is 20% given in the problem. So on what this 20% has to be calculated? On the equity share capital. So equity share capital is given in the problem 20 lakhs. Is it 20 lakhs? No, 60 lakhs. Equity share capital is given in the problem 60 lakh rupees. On 60 lakh rupees, 20% is the proposed dividend. So 20% of 60 lakh, it comes to 12 lakh rupees of the proposed dividend on equity. Deduct, we'll get 5,76,800. This 5,76,800 is called the surplus. That means current year's profit we have disbursed. We have paid the income tax, we have paid the preference dividend, we have paid the equity dividend. After making all appropriations, the balance available in profit and loss account is 5,76,800. These are the basic calculations we require in this problem. Now we'll attempt a one by one question. The first ratio, it is asking you earnings per share. Even in the previous problem, we have applied the formula for EPS. Earnings per share is equal to PAT minus preference dividend divided by number of equity shares. PAT, profit after tax, minus preference dividend divided by number of equity shares. This is the formula for EPS. Not only in this problem, any problem, whenever EPS we have to calculate, remember the formula. So PAT, profit after tax. How much is the profit after tax? 19,56,800. Preference dividend are 1,80,000. Divided by number of equity shares given in the problem. In the problem, 30,000 equity shares are given. So divide by 30,000. So deduct 19,56,800 minus 1,80,000. 17,76,800 divided by 30. 59.23 rupees. 59.23. This is the EPS, earnings per share. This you'll get in rupees. So first ratio completed, EPS. Second ratio, it is asking you book value per share. Again, remember the formula. First time we are applying this ratio, book value per share. It is there in the list. In the starting video, I have explained you about this ratio also, book value per share. You have the formula. What is the formula? Equity shareholders fund divided by number of equity shares. Equity shareholders fund divided by number of equity shares. So what is equity share capital? Equity shareholders fund. Equity share capital plus reserves plus surplus. Equity share capital plus reserves plus surplus. What is the surplus? P&L account balance. P&L account balance is called surplus. So here equity shareholders fund, equity share capital plus reserves plus P&L account balance. Equity share capital 60 lakh. Reserves 44 lakh given in the problem. Reserves at the beginning of the year 44 lakh. And surplus P&L account balance 5,76,800. Total 1,09,76,800. 1,09,76,800. This is the shareholders fund. Equity shareholders fund. Now we substitute. Book value per share is equal to equity shareholders fund divided by number of equity shares. So 1,09,76,800 divided by 30,000. You will get 365.89. This is the book value per share. So two ratios we have calculated. Now earning yield ratio. The earning yield ratio is the inverse of price earning ratio. Is the inverse of price earning ratio. Already I have explained this in the first video. Price earning ratio is MPS by EPS. Price earning ratio, last video also I have explained you. Price earning ratio is MPS by EPS. Earning yield ratio is inverse, ulta. EPS by MPS. Earnings per share divided by market price per share. So this is the formula, earning yield ratio. EPS by MPS. Earnings per share already you have calculated 59.23. And market price per share given in the problem. In the problem last line it is given market price per share is 400 into 100. So when we calculate earning yield ratio, you should calculate in percentage into 100. So 14.81% is the earning yield ratio. Next ratio, dividend payout ratio. This is also one of the ratio. First time we are applying, but it is there in the list. In the beginning we have discussed. Dividend payout ratio, the formula is DPS by EPS into 100. DPS, dividend per share, EPS, earnings per share, right? So earnings per share already we have calculated, but dividend per share we have not calculated. Now we have to calculate dividend per share. So what is the formula for dividend per share? Proposed dividend on equity divided by number of equity shares. How much is the proposed dividend on equity? Here you can see 12 lakh. Proposed dividend on equity is 12 lakh. How many shares are there? 30,000 shares. So 12 lakh divided by 30,000. You will get DPS. Dividend per share rupees 40. Now easily we can find out DP ratio, dividend payout ratio. DPS by EPS into 100. DPS 40 rupees. EPS 59.23. 40 divided by 59.23 into 100. 67.53%. This is the DP ratio, dividend payout ratio. One more ratio, price earning ratio, PE ratio. Here already last problem also we have applied. Market price per share divided by earning per share. P stands for market price, E stands for earning. So market price per share is given in the problem 400. And EPS we have calculated 59.23. So 400 divided by 59.23, 6.75 times. While calculating this price earning ratio, you should write down times. That's it. So these are the 5 questions asked in this problem number 10. Now 11th problem. See the 11th one. The following is the balance sheet of A Limited as on 31st December 1990. A traditional balance sheet is given liability side, left hand side, right hand side, assets. The liabilities are share capital 20,000 shares of 10 each, 5 rupees paid up, 1 lakh. Reserves and surplus 65,000, 5% debentures 1 lakh. Creditors and bills payable, these two are current liabilities. Now land and building, plant and machinery, these two are fixed assets. Then stock, debtors, bills receivable, cash and bank, these are the current assets. Last one, preliminary expenses, it is a fictitious asset, imaginary asset, not a real asset. So preliminary expenses is a fictitious asset. First time we are coming across in this problem. Now sales for the year is 6 lakh rupees. Sales for the complete year is 6 lakh. Rearrange the above balance sheet in a form suitable for analysis and calculate the following ratios and offer your comments. So first of all, the balance sheet is given in a traditional form. Now we have to rearrange the balance sheet in a form which will be suitable for analysis and interpretation. So here it is given in T form, left hand side liabilities, right hand side assets. We make it in a tabular form. In which one column will write down all the values. So first we convert the balance sheet in a form suitable for analysis like this. First our particulars amount. Share capital 1 lakh rupees given on the liability side. Reserves and surplus 65,000. So if you add up share capital and reserves, you get 1,65,000. From this, I am deducting the fictitious asset. Fictitious asset is preliminary expenses. So preliminary expenses, deduct 5,000, 1,60,000. This is called shareholders fund. Shareholders fund consists of share capital plus reserves minus fictitious asset. So one item we got shareholders fund. To shareholders fund we add long-term debt. The long-term debt is debentures given in the problem. So debentures we add up 1 lakh. So total 2,60,000. Now shareholders fund plus long-term debt is equal to capital employed. This 2,60,000 what you got is capital employed. In this 2,60,000 we have shareholders fund and also long-term debt. So below that we'll take the fixed assets. Fixed assets are land and building, plant and machinery. Total fixed assets are 2 lakh. To total fixed asset we add net working capital. Net current assets, not working capital, net current assets. Even you can call it as working capital also, because working capital and net current assets means one and the same. So take the total of current assets minus total of current liability. The resulting figure is called working capital or net current assets, means same. So what are the current assets? Stock, debtors, bills receivable, bank balance. Take the total 85,000. Current liability are creditors, bills payable 25,000. 85,000 current assets, 25,000 current liability. 85 minus 25 gets 60,000. This 60,000 is called net current assets. Now you add up 2 lakh plus 60,000, 2 lakh 60,000. That means tally it. Here also 2 lakh 60,000, here also 2 lakh 60,000. This is the form of balance sheet. It is also a balance sheet. But this balance sheet is suitable for analysis and interpretation. Now, after completing the balance sheet, we'll start the ratios. First ratio, it is asking you debt equity ratio. Already so many problems we have applied the formula. Hope you remember the formula. Debt equity ratio is equal to long-term debt divided by shareholders fund. Long-term debt divided by shareholder. Long-term debt means debentures. Long-term debt means debentures. How much are the debentures? 1 lakh. And shareholders fund. Already we have the shareholders fund here. Shareholders fund are 1,60,000. No need to separate calculate. Already in this balance sheet we have calculated shareholders fund 1,60,000. So 1 lakh divided by 1,60,000, 0.625. 0.625 is the debt equity ratio. Next, proprietary ratio. Net worth by total assets. That is the formula for proprietary ratio. Already in the previous problems we have applied. So net worth, meaning of net worth, shareholders fund. Shareholders fund, net worth means one and the same. Already we have shareholders fund 1,60,000. Right? Similarly, total assets. Total assets means fixed assets plus current assets. Fixed assets plus current assets. How much are the fixed assets here? 2 lakh. Current assets 85,000. So 2,85,000 is the total assets. Now you substitute. Proprietary ratio is equal to 1,60,000 divided by 2,85,000, 0.56. That's all. Two ratios we have calculated. Now we'll come to the third ratio, current ratio. Current ratio formula, current assets by current liabilities. So current assets already we have 85,000, current liability 25,000. So 85 by 25,000, 3.4:1. That is the current ratio. Next is acid test ratio or quick ratio, means same. The quick ratio formula, quick assets by current liability. And what do you mean by quick asset? Current asset minus stock minus prepaid. So current asset we got 85,000 from here. Stock is 50,000. Prepaid expense are not there. So 85 minus 50, 35,000 is the quick assets. Now you substitute quick ratio 35,000 by 25,000. 25,000 is the current liability. 1.4:1. That is the quick ratio. Next ratio, it is stock turnover ratio. It is asking you to calculate stock turnover. The original formula for stock turnover ratio is COGS, cost of goods sold divided by average stock. But due to lack of information, we can apply alternative formula also if there is no information in the problem regarding cost of goods sold. In our problem, we don't have full information about cost of goods sold. So in place of COGS, I am taking sales. In place of COGS, I am taking sales. Average stock we can calculate if we have opening stock. But opening stock is not given in the problem. So we can take the closing stock. So the alternative formula, sales by closing stock. 6 lakh sales given in the problem. 50,000 rupees is the stock. So 12 times is the stock turnover ratio. Next is average collection period. Last and final ratio, it is asking you to calculate average collection period. So before calculating average collection period, you must know debtors turnover ratio or receivables turnover ratio. The formula for debtors turnover ratio, net credit sales divided by average debtors. Net credit sales, again, we don't have the information about cash sales, credit sales. We have only sales. The alternative formula is sales divided by average debtors. We can calculate only when we have opening debtors. But in our problem, opening debtors are not at all given. So we can't calculate average debtors. We'll take the closing debtors. Closing debtors. Closing debtors are there. 10,000. So substitute 6 lakh divided by. One more point. In this debtors, it includes bills receivable. Already in the previous problem I told you. When we calculate debtors turnover ratio, debtors must include bills receivable. Bills receivable are also part of debtors only. So we have to club both debtors and bills receivable. How much are the debtors? 10,000. How much bills receivable? 5,000. So total debtors will take 15,000. Will take 15,000. So 6 lakh divided by 15,000, 40 times. So debtors turnover ratio is 40 times. But we need to calculate average collection period. It is called average collection period, or it is also called debt collection period. Both means same. So the formula for average collection period, number of days in a year. Number of days in a year divided by debtors turnover ratio. Number of days in a year divided by debtors turnover ratio. The number of days, 365 days in a year, divided by debtors turnover ratio, just now we have calculated. So without calculating debtors turnover ratio, we cannot calculate average collection period. So before calculating average collection period, calculate debtors turnover ratio. So 365 divided by 40, 9.125 days. This average collection period you will get in days. So 9.125 days is the average collection period. See, we have calculated all the ratios. So the new point in this problem is the balance sheet is reproduced, modified in this form, so that it will be helpful for analysis and interpretation. Easily we can calculate the ratios if we present the balance sheet in this format. But if it is asking in the problem, then only we have to present it. Otherwise, directly we can calculate, right? So after calculating the ratios, it is also asking you to give the interpretation, comment on this data. So first of all, debt equity ratio. Debt equity ratio shows the proportion of debt compared to the shareholders fund. So we got the debt equity ratio of 0.625. That means the debt is 62.5% of the capital of the shareholders fund. The debt is 62.5% of shareholders fund. So it is better to keep the debt, because debt will act as a leverage in lifting the profitability. When we keep some debt in the business, our profitability will increase. A business should not depend only on owner's fund. Apart from owner's fund, a business must take the debt. So it is having sufficient debt. So from business point of view, having a sufficient debt is good. The long-term solvency is better. Secondly, proprietary ratio. Proprietary ratio shows the proportion of total assets which are financed by shareholders fund. Proportion of total assets which are financed by shareholders fund. So we got 0.56. That means 56% of the total assets are financed by shareholders or owners. Remaining 44% is financed by outsider. 56% are owned, the assets, 56% are owned by the owners. Remaining 45% are financed by outsiders. Next one, current ratio. Current ratio shows the ratio of current assets to current liabilities. We got 3.4:1. For example, for every 1 rupee of current liability, the current assets are 3 rupees 40 paisa, 3.4. In other words, the current assets are 3.4 times of current liability. The standard current ratio is 2:1. If it is more than 2:1, it is better. So here the current ratio is better. The liquidity position is good. Asset test ratio, quick ratio. The standard quick ratio is 1:1. But here we are having 1.4:1. It's good. It is more than standard. Then stock turnover ratio. The stock turnover ratio shows how many times we can be able to convert the stock into sales. We got 12 times. It's very good. More than 8 is good. A standard stock turnover ratio is 8. If it is more than 8, it is very good. Here we have 12 times. In 1 year, 12 times we are converting the stock into sales. That means every 1 month. Every 1 month we are converting the stock into sales. It's a good, presentation. Next one, average collection period. The average collection period shows how much time period we are allowing to debtors. So we got average collection period of 9.125 days or around 10 days. That means only 10 days credit period we are allowing to the customers. It's very low. Because if we increase the credit period, normally sales will increase. The customers wants long credit period. If we keep very low average collection period, that means our sales will decline. So we suggest the company to increase the credit period. Instead of giving 10 days, we give 30 days or 60 days, 1 or 2 months. Like that, if the company gives a little bit more average collection period, that means credit period, then definitely the sales will increase. So ultimately, from these ratios, it appears that the financial position of the business is good. That's it. So this is the completion of problem number 11. So in this video, I've explained you 10th and 11th problem in detail, each and every point. So if you are satisfied with my lecture, give a like to the video. Share my channel in your friend circle, in your group, so that more students can watch the video and increase the knowledge. Give your comments on these videos, and lastly, don't forget to subscribe my channel. We'll continue the next problem in the next video.